Hello everyone, this is the quiz review video on break-even analysis, which is chapter 21 in Pearson. First thing we have is this situation, that Sullinger Sandals wants to generate operating income of $96,000 from sales on each sandal line. Sullinger also knows that they expect to incur $300,000 worth of fixed costs related to sandal production, so things like their rent and their insurance. They expect to sell each pair of sandals for $20 a piece, and then each pair of these sandals is going to have a variable cost of $8. That's the costs of production. So things like the plastic and rubber needed to make the sandals, things like the wages we're going to have to pay our machine operators to run the machines which produce the sandals. All of those things are going to be our variable costs because they vary depending on how many sandals that we make. First thing we can figure out from this information is our contribution margin. And contribution margin is simply the amount of your selling price that is left over after you've accounted for the cost of production. So if we plan on selling each pair of sandals for $20, and we know each pair of sandals is going to cost $8 to make, that means that $12 of that selling price is going to be left over after we recouped our cost to actually make the sandals. And we can use that $12 to contribute towards paying our other costs, namely our fixed costs, rent and insurance, etc. We can also express this in terms of a ratio, and to do so you take your unit contribution margin, ours is $12 per pair of sandals, divide it by your net sales revenue per unit. We're selling each pair of sandals for $20 a piece, which means that 60% of the selling price of each pair of sandals is going to be left over to contribute towards paying our other costs after we've already taken out the cost it was to produce those in the first place. We can use that info to find out what our required sales volume is in terms of both units and revenue in order to meet our goals. And our goal is still to cover our $300,000 of fixed costs and have $96,000 of operating income left over. So to figure out our required sales in units, we're going to take our fixed costs, add to it any profit we want to have as our goal, and we're going to divide that by our unit contribution margin to figure out how many pairs of sandals we have to sell. Well, Sullinger's fixed costs are $300,000. Their target profit or operating income in this case is $96,000, which means they're going to have to come up with $396,000 worth of contribution margin in order to pay those $300,000 of fixed costs and still have $96,000 left over. Well, if we divide that $396,000 we need by our unit contribution margin, which we just determined was $12, that means that we're going to have to sell 33,000 pairs of sandals in order to make enough money to cover our fixed costs and have the level of operating income that we desire. We can figure this out in terms of dollars as well by using a very similar formula. We take our fixed costs, we add to it the target profit or operating income we want to have, but this time we're going to divide by our contribution margin ratio. So our fixed costs are $300,000. We want to have $96,000 of operating income, so we still have to come up with $396,000. Well, if we divide that by our ratio of 0.6, the 60% of each unit selling price that's going to be left over to contribute towards paying those fixed costs, we come up with $660,000. So of those sandals we sell, we're going to have to generate $660,000 in revenue in order to cover our variable cost of production, in order to cover our fixed costs, our rent and our insurance, our administrator salaries, and still have $96,000 of profit left over. We can check to make sure our numbers are correct by preparing a contribution margin income statement. So the first thing we want is our sales revenue. And if you take your required units and multiply it by your proposed selling price, you get your net sales revenue that's necessary in order to get to this level of operating income. That's $660,000 because we had 33,000 pairs of sandals that we have to sell, and we're proposing to sell them at $20 a piece. And you probably noticed that this is also the answer that you get when you do the required sales in sales dollars formula. Those two numbers should always check out to be the same. Moving on to our variable costs. If we take our required units, those same 33,000 pairs of sandals, multiply it by the unit variable cost. The cost of production for each pair of sandals was $8. Means that Sullinger is going to incur $264,000 worth of variable costs if they're going to produce this level of sandals. Contribution margin is always sales revenue minus variable costs, so they're going to have a contribution margin of $396,000. Well, if they pay their $300,000 worth of fixed costs from that contribution margin, they are going to have operating income left over of $96,000, so our numbers all check out. And while that worked out fine, the problem with this is that costs of things are going to constantly change. Look at our variable costs. We have materials, we have labor, we have some variable overhead. These are all going to go up. Price of materials, whoever we're buying our rubber and our plastic from is eventually going to increase their price. Labor, every time that there's an adjustment to minimum wage or a cost of living raise, any of those things, our cost of labor is going to go up. All of these are going to increase our cost of production and change the certain level of sales we have to meet our goals. Same could be said for fixed costs. Our landlord could jack his rent up, our administrators could get a raise. All of those costs are going to go up as well. So for Sellinger, what's going to happen to them is their fixed costs are going to increase by 10%, and the variable costs of production are going to increase by $2 for each pair of sandals. So now what are we working with? Well, Sellinger Sandals still wants to generate operating income of $96,000 from sales on its beach sandal line. But the things that were true before are no longer true. What are we working with now? First, Sellinger expects to incur $330,000 worth of fixed costs related to this production of this particular line. How did I get there? Well, it was $300,000, but it increased by 10%. So if we take $300,000, multiply by 1.10, we now have $330,000 worth of fixed costs. We still plan on selling sandals for $20 a pair, but our variable cost has changed. It was $8 before, but we just had a $2 per unit increase to our variable cost, which means now each pair of sandals is costing us $10 to produce. Well, this is going to change our contribution margin. Selling price of $20 minus the $10 it's costing us now in variable cost to produce each pair of sandals means that for each pair that we sell, we're only going to have $10 left over, which can contribute towards paying our fixed costs. Or expressed as a percentage in the contribution margin ratio, now only 50% of the selling price of each pair of sandals is going to be left over towards contributing to pay those fixed costs. So let's find our required sales in units. We have $330,000 worth of fixed costs we have to cover. We still want to have $96,000 in operating income. Well, even though our inputs have changed, we can still use the same exact formula. So let's take our new fixed cost of $330,000, add to it our target operating income of $96,000. Now we got to come up with $426,000 in order to pay our fixed costs and have the amount of profit left over that we want. We divide that by our new unit contribution margin of $10 per sandal. Our required sales in units have jumped to 42,600. So now we got to sell significantly more sandals because we got more costs to cover and we have less contribution margin for each pair of sandals. We can do the same thing in dollars. The inputs have changed, but the formula is still exactly the same. So let's take our $330,000 of fixed cost, add to it our $96,000 operating income we want to have. We got to come up with $426,000. Well, our ratio declined to 50%, so if we divide that $426,000 by 0.5, now we have to do sales of $852,000 in order to meet our goals of paying off our fixed costs and having $96,000 left over from sales of this particular product line. Let's check our math one more time with a contribution margin income statement. Required sales volume is now 42,600 pairs of sandals. We're still selling them for $20 a piece, which means we got to come up with $852,000 worth of revenue. If we sell those $42,600 worth of sandals and each one costs $10 to produce, well, we're going to have $426,000 of variable costs. And to find our contribution margin, we take our sales revenue minus our variable costs, also going to be $426,000. Now we go and we pay our fixed costs, which have increased. They're now $330,000, but we're still going to have $96,000 for the operating income. Our numbers checked out. So this wasn't great for Sellinger. Like, they significantly had a huge increase in the number of sandals they have to sell and the amount of sales revenue they have to generate. How would they fix this from a managerial perspective? The easiest option is they need to increase their selling price to a point that's higher than $20. Like, $20 is no longer enough to meet their goals realistically. So they might want to go look at selling their sandals for $22, $23 a piece and see if there is still customer demand at that particular price point. So what we just worked through was what happens when a company has just one particular product line they're trying to figure it out for. Well, companies don't. They sell tons and tons of different products, and they don't sell an equal amount of every single product in their product line. So that concept they have of having a lot of different products, but you're selling each individual product in that group at a different level, is called a product mix. We have Santori Supplies, and they sell small kitchen items. Company has made its name producing shakers for spices. Their two most popular shakers are the salt shaker and the pepper shaker. We're going to keep this to just two products to keep it simple. Here's what is true. They expect to sell 3 salt shakers for every 2 pepper shakers they sell. These salt shakers are going to sell at $4 a piece, and they cost $1.50 to produce. That's their unit variable cost. The pepper shakers are going to sell for $3.50 a piece, and they have that same unit variable cost of $1.50. And they expect that their fixed cost related to production of these shakers is going to be $69,000. Well, now we need to determine our weighted average contribution margin. We're going to do so by using this table. So let's start with our salt shakers. Unit sales price. Given in our information, they're going to sell each salt shaker for $4. The pepper shaker sells for $3.50. That is the pepper shaker's unit sales price. Let's subtract out our unit variable cost. Each shaker, regardless if it's a salt shaker or a pepper shaker, is going to cost $1.50 to produce. Well, we can figure out our unit contribution margin for our 2 distinct product lines. The salt shaker is going to have a unit contribution margin of $2.50. The pepper shaker's contribution margin is going to be $2. Now we can figure out what our sales mix is. And what the sales mix is how many units of one type you expect to sell for the units of the other type. We expect to sell 3 salt shakers for every 2 pepper shakers. In the total column, simply add those 2 numbers together and you're going to come up with 5. And they call that bundle size. It's mainly used for calculations. You'll see how it works here in a second. But what it means is that 3 out of every 5 shakers we sell are going to be salt, and 2 out of every 5 shakers we sell are going to be pepper. Well, let's take our unit contribution margin, multiply it by the number of that particular unit within our sales mix, and that's going to give us our overall contribution margin for that particular model. So for the salt shaker, we take the $2.50, we multiply it by 3, and we get $7.50. For the pepper shaker, we take $2, we multiply it by 2, we get $4, which means our total contribution margin for each, they call it bundle, that we're going to sell every 5 units is going to be $11.50. If we do indeed sell 3 salt shakers for every 2 pepper shakers. Well, now let's do our calculations. Instead of just having a unit contribution margin, we're going to have a weighted average unit contribution margin. So that means for any one unit we sell, regardless of what it is, what can we expect our contribution margin to be given our particular product mix? And to figure it out, you're going to take your total contribution margin and divide it by your total sales mix. So we had a total contribution margin of $11.50. There are 5 units in our bundle, if you will. $11.50 divided by 5 means that any one given unit that we sell during the period is going to have an average contribution margin of about $2.30, and we can use that for our calculations. First things first, let's determine our break-even for product mix. We have all of our information that was given in the question. We also have calculated what our weighted average unit contribution margin is. Well, now, if we go through and use this information, we can figure out our required sales in units, which in this case is going to be our break-even point units. Their fixed costs are expected to be $69,000. They're looking to break even, which means not make any money, not lose any money. So target profit, whenever it's a break-even question, is always going to be 0. They got to come up with $69,000 to cover their fixed costs. Well, let's divide that by our weighted average unit contribution margin, which we just figured out to be $2.30. Means that we're going to have to sell 30,000 units in total, so salt shakers and pepper shakers combined, in order to break even. But how much of each? Well, we